if the S&P is correct, if markets are rising, that means that earnings are improving and outlook is improving, and therefore economic data should improve following that within 6 months or so. Well, the market is telling us that within the next 3 to 6 months, we will see an improvement in the economic data to support the improvement in the price of the market, because that would suggest that then earnings are also improving for the market being a leading indicator of all this. Here's what you need to know before the bell. Markets are, as I said, back to 52-week highs, but analysts are now expecting that we will rapidly reach all-time highs by the end of this year. So again, markets on a very bullish positive trend. Market moving averages are all now rising, so this actually adds to that bullish uptrend in the markets. Again, lots of level of support between the 20-day, the 50-day, the 100-day, the 200-day moving averages, a tremendous number of levels of support for this market to keep it within a bullish trend through the rest of this year. Now, importantly though, none of this sets aside the simple fact that we can have a 3 to 5% correction anytime here this summer or early fall, getting ready to go into the end of the year. In fact, a 3 to 5% correction should be expected because that's normal within any given year, and a retest of the 50 or the 100-day moving average, which is that 3 to 5% correction, should be expected, and that will be a much better opportunity on a risk-reward basis to put capital to work in the market. The issue now, of course, is the economic data. The economic data continues to read pretty weak. In fact, on Monday, we had both the ISM manufacturing and the S&P Global Manufacturing Indexes both point to weaker economic activity. But yet, what we have now is a divergence between the market return for this year. So if you look at the annual rate of change on the S&P 500, that is rapidly increasing. And that has a very high correlation to the manufacturing indexes historically. So the year-over-year rate of change of the index has a high correlation to the annual change in the manufacturing. So what this is telling us is that if the S&P is correct, and as an example, we often look at the S&P index as a leading indicator of the economy because, well, if markets are rising, that means that earnings are improving and outlook is improving, and therefore economic data should improve following that within 6 months or so. Well, the market is telling us that within the next 3 to 6 months, we will see an improvement in the economic data to support the improvement in the price of the market, because that would suggest that then earnings are also improving for the market being a leading indicator of all this. Now, the question is whether or not you believe that, but there's a very long set of historical data that suggests that is exactly the case, that this rising price in the market, which is the wealth effect that Ben Bernanke and Alan Greenspan and others have spoken about historically, that leads to a more confident consumer. They look at their 401k plan, they look at their investment accounts, they have more money, so they feel more opportunistic and more optimistic about spending money in the economy, right? Because their wealth is rising. That's the belief that the Federal Reserve has about this creation of the wealth effect and its impact on economic data. Now, whether or not that's going to be the case this time because of the Federal Reserve hiking rates, because of them trying to slow the economic data, this is all up in the air for question right now. But historically, what the statistics say is that a rising market will lead to improving economic data. And the economic data has now been negative for over 15 months. We've been having a consistently negative economic data for 15 months. That's a very long stretch for an economic slowdown, recession or not. And so we should just start seeing some improvement, just historically speaking, from the cycle as companies have to start restocking inventory, people are coming back to work, et cetera. Again, looking at low jobless claims, low unemployment rates, everything the Fed has been trying to do in terms of slowing the economic environment really hasn't worked tremendously in terms of bringing inflation down. And so this is the big battle. The battle between the Fed and their inflation boogeyman and the market's expectation of a return to economic prosperity. Who wins this fight is going to be the victor here, and that'll mean whether investors are right or wrong is all going to be dependent on how this turns out. So again, this is why we continue. We don't know the answer, And this is why we continue to navigate these markets cautiously, but optimistically as prices are rising. So we want to use opportunities to increase equity exposure for now until the markets begin to tell us something different. But this is what you need to know before the bell this morning.